Hi, and welcome once again to another session in the topic area of FRM. And this time around, I'm going to discuss the curriculum for 2026. Now, for all of you who have had actually taken the FRM Part 2 exam, I've already discussed about the FRM Part 1 exam curriculum changes in 2026. Now I'm going to discuss about the Part 2 changes. And let me, uh, perhaps much to your surprise, let me tell you that the curriculum has really undergone massive change. So the ones who would be taking their FRM exam for the first time, or the ones who are actually taking it, uh, retaking the exam, uh, you better be advised that please do not refer to any of the outdated curriculum books. They are not going to help because, in particular, you should refer to the new books of GARP, or even if you're using any third-party prep provider material, insist for the latest version and the latest uh, books that contain the curriculum changes, the updated curriculum that is. So let me tell you that at the core of it, we still have those same six subjects: market risk, credit risk, and operational risk. These are the three core subjects, along with the periphery subjects that we have that compose the liquidity and the treasury risk. We have the risk management and investment management and current issues. In particular, the changes in liquidity, the core block that has remained unchanged. So there is no change whatsoever. In fact, the relative weights of the subject areas have also remained unchanged. There is no change towards that. In the curriculum per se, also, there is no change. So the core area of the 60%, that remains as they were in 2025. However, the one that's left out, that is the balance 60%, and that is where I tell you that the investment management, this 15%, is the one where massive change has actually taken place. Of course, the current issues have also undergone change. Uh, that's, of course, was expected because it was due for some time. So the current issues need to be more relevant, and that's precisely why that they have also undergone change. But in terms of the depth and the quality of curriculum, I say that you should be thoroughly prepared with this new investment management. So I say that around 30% of the curriculum have actually undergone major changes, which you can only do justice to if you're preparing for the 2026 May, August, or the November windows by referring to new books only. I cannot overemphasize this point any further. The liquidity and the treasury risk, there's only been minor changes only, and let's now boil to the specifics of them. So uh, number of chapters. First and foremost, there were 104 chapters, which is now increased on a net basis. Few chapters have been eliminated. Few chapters have been shifted from one topic area to another topic area. We're going to discuss about that as well. But on a net basis, three chapters have been added. So 104 readings have actually given way to 107 readings. So of course, that would mean that there's some extra effort that's required. Majority of the changes have been in investment management, and that's where, in particular, alternate investment, that is new hedge fund strategies as part of reading has been incorporated, has been included, and the concurrent risk management and the risk that entails the hedge funds as an asset class, that also will be included in your curriculum. That has also been included. Of course, the current issues, as I said, that entirely new set of readings, which spans your climate risk, CBDCs, artificial intelligence, cybersecurity, geopolitics, and Basel IV, the impending Basel IV that's there. And as far as the liquidity and treasuries, there is not much of a change. There's just been some cosmetic changes. And I said that some relevant examples regarding Basel have only been updated, and that's just about it. I quote one of the learning outcome statement: under liquidity risk management, evaluate Basel III liquidity risk ratios and the banking for international settlement principles, or the BIS principles, for sound liquidity risk management. So this is more of a qualitative aspect, and let me tell you that this is nothing new. You would have already learned before as well. So I don't want you to be bogged down by this. This changes us purely cosmetic. There isn't much change. Similarly, treasury risk management, there is only minor revisions to case studies, no structural changes. And as has been stated, that uh, one, as compared to 2025, there are about 17 readings that are included in 2026. One has been dropped, which is basically managing and pricing deposit services. And the reading number 19 that was there, that has been moved from liquidity and treasury risk to risk investment and investment management. Okay, so illiquid assets have been moved to risk investment and investment management portion. All right. Now, talking about current issues, these are the broader topic areas. Of course, artificial intelligence takes the core of it. Private credit is, of course, you would have had already studied private credit, or this was already there prior to 2026, but there is a significant bit of an extension that's been added in current issues, and the same is also reflected in the risk and investment management as well, which specifically tells us that your private credit, then you have distributed ledger transactions, artificial intelligence. These are the new flavor of GARP. These are the new sources of risk that GARP would like to cover, and there are seminal papers which GARP has actually referred to in designing the curriculum. These are the two topic areas which have actually all put together been introduced as something new. So cryptocurrency and digital assets and digital resilience. Total number of readings have remained 8, as it were in 2025. Rise and risk of private credit, this has been moved to risk investment. As I said, that risk investment all put together earlier before 2026, there were about 11 readings. Now we have 17 readings. Of this, 4 obviously are new readings, and a couple of them have been moved. One, as I said, from the liquidity and treasury risk, that's basically your illiquid assets. And second is your rise and risk of private credit that has been moved from current issues to risk and investment management. All right. Now let's talk about the topic areas in a broad manner as far as current issues are concerned. The focus shift, and I read out because these points are significant. So I want you to pause this portion of the video and refer it for yourself. That advanced focus on artificial intelligence and its adoption by market participants, vendors, regulators. This is a shift, major shift, as I said. Then there are talk about granular model developments and implication on financial stability, modern tools deployment in cyber risk, cybersecurity, market correlations, fraud, disinformation, misalignment, etc., etc. Geopolitical risk. So it's just not limited anymore to your Russia-Ukraine war. As you would be knowing that global tensions are flying in and around everywhere. So what it actually entails, as far as most significantly as part of the tail risks, those areas are actually being thoroughly and very deeply covered this time around, and what it means for as far as the global financial stability is concerned. So I read out geopolitical risk and global financial stability in the light of war, emphasis on pricing of premium of equity and bond, modeling and pricing tail risk, the downward risk that is. Resilience of bank, of course, stress testing, new means of stress testing, new models of stress testing, the big data, the LLM models, how they are actually making inroads in stress testing, and it's becoming a necessary tool altogether, an indispensable tool, gradually, of course, in the hands of the national regulator and the supervisory banks. The emergence of tokenized assets and distributed ledger, impact of distributed ledger technologies on retail investor and brokerage firm. This is a very, very significant thing, because my understanding is that going forward, 2027, 2028, or even further, you're going to see an extended version of this particular LOS. So candidates, it's perhaps is in your best interest that you should pay special attention to this particular LOS itself. Not that any of them, all 5 of them are, as all 5 or 6 along the focus shift that I'm talking about, all of them are important. But of course, some, this seems to be a little bit more than the rest of them. Okay, let's now talk about the topic area where the majority of changes have actually taken place. Investment management. So as I said, that there are about 5 to 6 new readings have actually been incorporated, and we're going to obviously talk about them in details. But let me just read out to give you some flavor that there has been some update as regards the risk budgeting and risk portfolio construction. Risk budgeting and portfolio construction as a topic area is nothing new, but it's a tiny bit of LOSS, a tiny bit of new elements have been incorporated here. Performance attribution, again, this have been updated with the version of with the view of the ESG integration, and this is something where I see a striking similarity with CFA level 3 as well. So that's what I'm saying, that sometimes it feels like the distinction between CFA L3 and FRM Part 2, that's kind of blurring as we are moving forward. Hedge fund strategies, and as I was mentioning, that this is the icing of the cake. Majority of the new strategies, as we are going to discuss, have now been incorporated. Mind you, they were actually part of your CFA level 3, and in fact is a detailed curriculum for your Kaya as well. That is Chartered Alternate Investment exam, if you're taking any of them. That is private equity risk. The risk that entails, this have been updated, and risk in asset management. As I said, the 3 old readings have been dropped from 2025. 8 new readings have been added. 2 readings have been moved from the other areas, which we have just discussed. So if you talk about the sub areas or the subsegments of the risk and investment management, I segregate them into 2 halves. The first half, of course, has remained relatively unchanged and benign, but the rest of them, as starting from here, that is hedge fund and private markets, risk monitoring and due diligence, scenario analysis and stress testing, and asset liquidity. This is where the majority of the changes have happened. And of course, candidates, you must have a completely new mindset to approach this exam. Earlier strategies perhaps will not do good if you're approaching them as you were perhaps in your FRM Part 1, or if you're taking the Part 2 exam as a returning candidate. Okay, now what I've done is that I've attempted to threadbare kind of discuss the risk management and investment management key areas where the majority of the changes have happened. For example, hedge fund strategies. So hedge fund strategies have entailed your macro equity hedges, your arbitrage strategy, convertible debts, event-driven distress securities, merger arbitrage. Now, these are something which are directly taken from the CFA curriculum, and because we have studied this extensively in CFA as well as in Kaya level 2 as well, but these seem to be making a heavy inroads in FRM for the first time. So these are strategies, and again, as I tell you, that you need to have a fair bit of an idea about the alternate asset class hedge fund before you can actually even discuss these strategies. And these strategies, mind you, they are going to be tested. They are going to be definitely tested in your forthcoming exam. Second block is that of the risk monitoring and due diligence. As I said, that here there is not radically something new that has been introduced, but there has been significant update. So, for example, risks in hedge fund, contribution to systemic risk, regulators' response in mitigating risks. So, I have highlighted only those portion that pertained to the earlier block of hedge fund strategies, because of course you cannot learn, you cannot read each one of them in isolation. No, that's not the case. So if you're learning about hedge fund strategies, you should be well aware about the risk monitoring and due diligence pertaining to the hedge fund strategies, those individual strategies as well, and how they can help you in making those bets or making those mitigating the risks that's there, how they might actually contributing to the overall national, if not the global systemic risk as well. The growth of private credit. Now, this is a new topic area, and I really congratulate GARC for including this as part of the curriculum, because this has been long overdue, because of this is a new emerging area as well. Because what I've seen in most of the emerging markets, that there is a gap that's being actually addressed by the private credit. And of course, what kind of risks that they entail, again, the same thing, that even though it's directed towards individuals or small and medium businesses, small shops, etc., those shops or those businesses which perhaps are not quite attuned or not quite qualified to secure credit from banks, they would be prime candidate for the private credits. But at the same time, of course, we must understand that they may also unnecessarily increase the risk. And such risks, of course, as we have learned from the 2007-2009 crisis, seldom remain confined within the area where it had become begetted from. So it's important for us to understand that how it is being viewed by national regulators, and how they are actually going to develop the framework to ensure that the spillovers from private credit growth do not affect the overall market as such. So I read out the characteristics of private credit market, how it differs from traditional lending and savings organization, risk and return profile, borrower's profile, regulators' response, framework for private credit. Again, the next block is about private capital investing, distress symptoms and remedies. Again, as I said that, if you're talking about hedge fund strategies, you need to understand the risk part of the hedge fund strategies as well. Similarly, the private credit, if you're talking about private credit, of course, at the same time, you should be aware about the risks that entail the private credit and the sources of those risks as well, and what are the mitigants. So sources of financial distress and indicators, different mitigating remedies and their potential implications, how the regulatory framework might develop, and then a case study from the Bernie Madoff. This is per se, I'm a little surprised because this is a very old topic per se. I don't know why it has actually now again made a reappearance after disappeared. It had disappeared for some years, and again Garth has reintroduced this. What's the logic behind this? I really do not understand. But then this is really an older topic. You really perhaps not need not really spend much time out here. This is fair and square. This is pretty open and shut case kind of reading. A market-driven scenario. Now, this is again a very important aspect because these are going to talk about those models which are not yet tested. Those are still in the alpha stages. Those are not the beta or even the beta stages, wherein gradually we are trying to test the waters by introducing these models and see that how they can help us in identifying the risks, market-wise systemic risk, or even private credit risk, or even operational risk, even before they can actually turn out to be something malicious or something far greater in scale. So those scenarios are actually being mapped. And please understand that with the advent of AI, these things can become that much more easy to do. So what are the key topic areas? What are the key learning outcome statements out here? So I believe that the steps in the market-driven scenario, first stress testing, calculation of the Z-score for volatility and correlation, and calculation of something called as Mahalanobis distance, and challenges in implementing the market-driven scenario. The last portion is the liquidity risk management, best practices in liquidity risk management, potential challenges for portfolio managers in managing liquidity risk in different kinds of bonds, ranging from government, sovereign, corporate, and the illiquid ones. Extraordinary measures permitted by regulators during redemption pressure, how the redemption waterfall may actually be structured in asset management companies as well as in banks as well, modeling redemption at risk and optimizing liquidity risk. So, parting question, as I said, that I'm kind of pleasantly surprised that the FRM Part 2 curriculum and the CFA levels, there has been a massive overlap, and it seems that at times they are in the mood to actually convert. So I famously quote that is CFA becoming FRM Part 3, or FRM is becoming CFA Level 4? That's for another day to actually see. But for now, these are the changes. I hope you enjoyed the show. And plus, I again make a piece of advice for all of you that have a fresh mindset as you approach the new curriculum, and the old books won't do. You will have to regroup yourself. You will have to start learning in a different manner as far as the exams are concerned. Good luck.